and people are going to start really getting nervous about the dollar. And who knows where we're going to be with the elections, or if there's going to be court cases and riots in the streets, and where the Middle East wars are going to be. I don't know. We've had like 4 bombs today that shook my house again. I mean, this is not stopping. So it's got to come to a head, and silver is going to be a big part of that.
You're watching Silver News Daily. Subscribe for more.
Did you know silver could soon reach all-time highs, while the dollar faces a potential freefall? Rafi Faber has laid out a shocking forecast that sees silver skyrocketing as global confidence in the dollar wanes. Sounds too wild to be true. Stay with me as we dive into why Faber believes silver might be the last refuge when currencies collapse and the world shifts away from the dollar. This is a story you don't want to miss.
And that is, somebody asked, why does it matter if the reverse repos run out? They've been zero for most of history until, 2021. And, you know, there were some, like a few $100 billion. Yeah, that's a small number today, you know, in like 2014, 2015, 2016, but most of history, it was zero. So why would it matter if they go to zero again? It's a great question. And the answer is, it's inherent in what credit really is, or how the Keynesian inflationary fueled economy works, right? We're not really a money-based economy. We're a credit-based economy. And, you know, credit is issued, and that's how businesses work, and it's how international businesses work. And there's just circuits of credit with people trusting each other. And the actual money that's supporting it all is very, very low, very, very small amount. And if you look at the Fed's balance sheet, the amount of gold is like 8%, and the rest is just debt, which is credit. And debt and credit are the same thing. They're 2 sides of the same coin. If the credit supply can't shrink, and it cannot shrink in an inflationary system, then debt can never really default. Because if it defaults, or it's paid back and it's extinguished, or it can never really be extinguished, then the business cycle turns, you get a bust, they get the bank crises, because banks don't lend money, they lend credit these days. So what really happened from about World War II until 2008, the credit supply gently increased. The Fed had pretty much control within larger cycles of the monetary system, and the circuits of credit kept going. But in 2008, they all kind of fell at the same time. Then you had all of this bad credit or bad debt, which is really the same thing. And the Fed had to buy it all, put it on its balance sheet in order to keep the banking system going with the fuel that it had been on for the previous decades. And now you have all these bank reserves, right? They bought the bad credit, and they bought it with dollars, right? They said, here, give me the bad debt or the bad credit, whatever you want to call it, and we'll give you these dollars, and you can put them in the basement. And that's bank reserves. But banks can't just sit on reserves. Every bank competes with every other bank, so they have to earn interest on these things. So they either put them in the derivatives market, or wherever they fit to earn some kind of interest, or they put them back in treasury paper, wherever it is that can earn interest, right? And now,
let's set the stage by looking at where silver stands in today's market. In recent months, silver prices have experienced a mix of highs and lows, but they're now pushing resistance levels at around $34, close to the all-time high threshold. This price movement comes at a time when silver demand is being driven not only by its traditional investment appeal, but also by its crucial role in several high-tech and green industries. From solar panels to electric vehicles, silver is becoming an irreplaceable metal, which has attracted substantial attention from both institutional investors and major corporations worldwide. But what's causing this recent surge in silver interest? For one, investors are increasingly worried about the future of the dollar as economic pressures intensify. Treasury yields, which typically act as a barometer for U.S. financial stability, have been rising rapidly. Higher yields often signal market anticipation of inflation and economic instability, which has historically driven capital toward precious metals like silver. So while the U.S. dollar remains a pillar of global finance, These indicators are forcing some to rethink where they're putting their money. Even short-term silver investors are taking notice. Just last week, silver hit a session high of $34.87, marking a 12-year peak that's reignited interest in precious metals as an alternative investment. However, resistance points at $34.35, $34.87, and a critical $35.40 level remain a challenge. If silver breaks through these points, many analysts believe we could be looking at a new chapter for this metal, one where it could break through its historical highs and become a key player in the global market reset we're about to explore. And with upcoming economic data expected to influence the Fed's rate decisions, silver's role as a hedge against the dollar has only grown more compelling. So here's a question for you. If silver is gaining this much traction already, what could happen to its price if the dollar's value truly begins to falter? Is silver simply a safe haven, or could it be primed for an unprecedented breakout? As we continue, we'll examine the underlying factors that make silver not just a hedge, but potentially one of the most powerful assets in a world where confidence in currency is waning.
They could have been. Look, there's a lot of theories, and none of us are ever going to know because we don't occupy these halls of power. But I mean, there are theories as to, the repocalypse happens in September 2019. The pandemic was technically, from a biological perspective, already happening at that point. People were being infected. It was spreading. It just didn't make the big news yet. And then, by January, February, which is the repos were ongoing. I have to check the chart, but I think it was like tens of billions of dollars a day. And the balance sheet was going back up. But some people say they needed an excuse to print money more directly. And so shutting down the world might have contributed to that desire to do that, to stabilize the monetary system, but give an excuse to do that. That it's possible. I mean, a lot of people are very insistent that that's what the truth is. I'm just going to maintain an agnostic stance on that because there's nothing I can do about it. Whatever happened, I don't know. I just know that when you print more money, gold and silver are going to go up eventually. And one more, and my thesis is one more printing round, and it's going to happen. So, it's interesting because we can really test that theory in a few weeks or months, right? We know the reverse repos are going to run out. We know that once that happens, bank reserves are going to fall. The Fed admits this, they admit explicitly in their papers, right? They say this bank reserves are going to fall, and then we're probably going to have to slow down QE. They say this. Oh, it's clear. It's obvious even to them. And now, if the pandemic was related in a monetary sense to the repocalypse of 2019, then we should see something like that happen again. Some other excuse to pop up to print trillions of dollars to alleviate the monetary tightness that the repocalypse is a symptom of, right? It means that there's other problems somewhere, but the repo is just one symptom of it. So if it's true, if they're right, then I don't know, God forbid it would be a big war. I mean, the stage is definitely set in the world for that. And we see it everywhere. We could have some election problems in the United States, some riots on either side, depending on who wins and who loses and who accuses who of cheating. This is all primed to explode, and we know it. I mean, imagine living like in 1914, right before Franz Ferdinand was assassinated, and then World War I breaks out. I mean, I'm not saying that World War III is going to break out like in a few months, but we're in the same sort of situation where the chess pieces have been aligned on different sides, in politically, geopolitically, in the Middle East, China, Russia. It's all ready for something to happen, and we don't know what.
To understand why silver might be on the brink of a historic rise, we need to consider the forces shaking the foundation of the U.S. dollar. For decades, the dollar has been the backbone of global finance, a trusted reserve currency used by countries and corporations worldwide. But this dominance is now being questioned. Rising inflation, mounting national debt, and an ever-expanding credit market have created a storm of instability around the dollar, leading some experts to warn that we may be heading toward an era of significant dollar devaluation. So what's driving this loss of confidence in the dollar? A key factor is the Federal Reserve's struggle to balance inflation with economic growth. Over the past year, the Fed has been caught in a cycle of interest rate adjustments aimed at controlling inflation, but each hike seems to expose new cracks in the economy. Higher rates increase the cost of borrowing, slowing down growth, yet failing to rein in inflation as expected. As a result, the value of dollar-denominated assets is weakening, making investors nervous about holding onto U.S. dollars as a stable store of wealth. Another major factor is the rise in U.S. Treasury yields, which recently hit a multi-month high of 4.3%. These yields reflect the growing uncertainty in the market, as investors look for safe returns amid looming risks. But there's a twist. While Treasury yields have risen, the attraction of holding dollars has started to diminish as inflation continues to eat into real returns. In this kind of environment, non-yielding assets like silver gain appeal as a hedge against devaluation. Complicating matters further, other global economies are quietly moving away from the dollar. Nations like China and Russia are advancing bilateral trade agreements in local currencies to reduce their reliance on U.S. dollars. Even U.S. allies have begun discussing alternatives to a dollar-dominated system, fueling fears that we could be on the verge of a global shift away from dollar reliance, a phenomenon often referred to as de-dollarization. If this trend continues, the demand for tangible assets like silver could soar, as these assets provide a shield against the volatility of a weakening currency. Given all this, silver's potential as a safe haven in the face of a devaluing dollar becomes even clearer. Investors and countries alike are questioning the dollar's future, and as this uncertainty grows, so too does the demand for a stable, tangible asset. Silver, with its unique blend of industrial and investment value, stands out as a prime candidate. So, here's the big question. If the dollar's grip on global finance truly begins to slip, will silver be the asset everyone turns to?
There are so many reserves that they don't even fit in the system because there weren't enough. It seems like a crazy statement, but there weren't enough treasury bills to for all the dollars in the system, and since they couldn't buy treasury bills, then it would cost them money to hold it. So the Fed said, "Give it back to us, and we'll give you interest as if you were buying treasury bills," and that's a reverse repo, right? So the banks give the Fed cash. The Fed the banks give the banks give the Fed cash. The cash give the banks treasury paper. Right? So it's basically a treasury bill, just a treasury bill that doesn't exist because there's not enough. All right. So the thing is, now the banks are used to having all these reserves. They've put them places different. They've tucked them away, like under mattresses and under this, like scary mattresses, not like a mattress that you sleep on, obviously, but like scary derivative mattresses where they have all these reserves. And now all the trades that they've held there are dependent on these reserves continually funding those trades. One example that I talk about in the Endgame Investor a lot is the basis trade, where hedge funds, banks, non-banks, anyone who wants to do this, shorts the treasury paper and then buys the spot and profits off the spread. And they use bank reserves to multiply this trade over and over and over again. And if you look at the COT reports, the positioning on these short positions on these treasuries, they're twice what they were the last time they hit a record, which was in 2019 when the apocalypse hit, when the repo markets blew up. And that's what it means, that all these reserves are funding all these derivatives markets. So if they run out, right, if these reserves run low and then these trades have to unwind all in the same day at the same time because of margin calls, then it knocks over other things. Like I'm just trying to picture in my head like what it could look like if you have like let's say a hedge fund that has a lot of these basis trades on its balance sheet, and all of a sudden they run out of repo dollars to fund them, and they have to close. And then let's say, well, or they need emergency cash to keep them going. Then what if one of these hedge funds has, like, let's say, a lot of real estate and it's got to sell it really fast to stay liquid. So then you have repercussions in the real estate market. I'm saying all these things are connected. So when the reversed repos run out, that means there's no more excess liquidity that couldn't be sopped up by treasury bills, and then reserves start to fall as they get used up. And there's some point in there where things start to unwind. And that's the point where the Fed's going to have to go in again. Exactly what they're going to have to do, I don't know. But last time they went back into repos, and there were like $500 billion in repos offered the next few months, something like that. But the balance sheet's going to expand. And then the question is, what is it going to spill into? Last time it spilled into some kind of disease out of China. Let's not speak of it. If that was connected or not, we don't know. And I'm not going to make any claims here, but could have been. We'll see what happens this time. But it's going to be the same story, just like twice as big.
One of the biggest developments in recent years has been the growing movement toward de-dollarization. Across the globe, countries are taking steps to reduce their dependency on the U.S. dollar, aiming instead to trade and hold reserves in other currencies. This shift is far more than a financial trend. It's a signal of a potential reshaping of the global economic order. As trust in the dollar fades, a wave of countries and corporations are searching for alternatives that might hold value in the face of economic shifts and geopolitical tensions. And in the scramble, silver could emerge as a powerful edge. To understand why, let's take a look at what's happening on the ground. Nations like China and Russia are leading the charge in de-dollarization, creating agreements to trade oil, gas, and other commodities in their own currencies rather than using the dollar as the intermediary. This effort isn't limited to these two. Other nations, wary of sanctions or economic leverage tied to dollar dependency, are exploring similar paths. The reason? Reduced reliance on the dollar means less exposure to U.S. economic policies and less vulnerability to currency-based sanctions, an attractive proposition for countries aimed to bolster their economic sovereignty. But what does this mean for silver? In times of global economic restructuring, tangible assets become more valuable as a way to preserve wealth. Precious metals, especially silver, are uniquely positioned because of their dual role as both a store of value and a critical industrial resource. With de-dollarization taking hold, many believe that the demand for assets outside the dollar, like silver, will increase as both nations and investors look for stores of value they can rely on. Silver isn't just a precious metal. It's a critical metal essential in sectors like energy, electronics, and green technology, giving it a substantial foothold in both the industrial and financial worlds. Here's the twist. As more countries turn to de-dollarization, they may begin to accumulate precious metals, including silver, as a safeguard against dollar instability. This could mean significant upward pressure on silver prices as demand outpaces supply. Remember, silver is already limited in supply, and its industrial demand is only increasing. Imagine a scenario where not only individuals but nations themselves start accumulating silver as a reserve asset. This unprecedented demand could be the catalyst that drives silver prices to heights we haven't seen before. So, here's a question to consider. If global economies are diversifying away from the dollar, could silver become the next go-to asset for nations looking to safeguard their wealth? And if so, what impact will this have on silver's value in the years to come?
Good question. I don't know when. Look, it's a double-edged sword when you talk about premiums. Because on the one hand, you could say premiums are very low, and therefore we're not in a bubble because we still have the retail the retail buyer to come in, and they haven't come in yet, so there's more fuel. On the other hand, if you look at the premiums in 2010, 2011 for silver, junk silver, like the quarters, dimes, half dollars, those kind of 1964 and earlier, they were actually below zero, right? It means it was cheaper to buy physical silver from, I don't know specifically Miles Franklin, but a retailer in a coin shop than it was to buy SLV, right? Briefly in 2011, like let's say when silver was like going from 40 to 50. So for like a few months in that time span, it was cheaper to buy physical coins. That's a sign that silver was in at least a derivative based bubble, right? It was the hedge funds and whoever buys ETFs and futures. They were chasing the silver price higher, or they were caught in some kind of spiral, and it wasn't being reflected in the physical markets. Now, premiums are low, but they're still positive. It's still, it still costs a premium. I think it's like 6-7% for junk silver, which means that I mean, there's still some demand in physical markets. So it's not like buyers have totally given up and they don't even want it, right? Which was the case in 2011 briefly. So look, when do the retailers or the stackers come in again? I think when the next printing round starts, right after this is going to be after the next repo crisis, and the Fed's going to have to say, look, we're going to have to cut back down to zero, or we're going to have to cut 100 basis points overnight, something like that. I think then the premiums are going to start to rise again, and people are going to start really getting nervous about the dollar, and who knows where we're going to be with the elections, or if there's going to be court cases and riots in the streets, and where the Middle East wars are going to be. I don't know. We've had like 4 bombs today that shook my house again. I mean, this is not stopping. So it's got to come to a head, and silver is going to be a big part of that coming to a head.
At the heart of Rafi Faber's bold prediction for silver lies a deeper economic issue: the potential collapse of the dollar due to an unsustainable credit system. According to Faber, we're not simply dealing with temporary inflation or periodic market volatility. Instead, we're looking at a looming crisis within the very structure of the U.S. economy. The problem, he suggests, is a complex web of debt and credit that has grown unchecked for decades, making the dollar's stability increasingly fragile. The U.S. financial system, as Faber explains, is heavily credit-based. For years, credit has been issued as a substitute for actual currency, fueling the growth of businesses, the stock market, and international trade. But here's the catch. This credit expansion relies on constant borrowing and minimal debt defaults to keep the system intact. In an inflationary environment, however, the cracks start to appear. Higher borrowing costs from rising interest rates make it harder for corporations, individuals, and even the government to manage existing debt, let alone take on new obligations. Consider this. As interest rates climb, the U.S. Treasury must pay more to service its debt. This isn't just a problem for private investors. It's a systemic issue that touches every corner of the U.S. economy. When debt becomes unmanageable and credit starts to dry up, the result is a credit squeeze, which forces businesses and financial institutions to sell off assets rapidly to cover their obligations. This fire sale scenario is exactly what Faber warns could happen, leading to what he describes as a credit collapse situation, where there's simply not enough liquidity to keep the system running smoothly. So where does silver come into play? In times of severe economic instability, tangible assets like silver have historically served as safe havens. Unlike credit or fiat currency, silver doesn't rely on any institution or government for its value. It's a real asset with intrinsic worth, making it highly attractive in times when the reliability of financial institutions and currencies comes into question. Faber believes that as the dollar's fragility becomes more evident, silver will stand out as a reliable store of value. This scenario brings us to a critical question. If the economy does face a major credit collapse, where will people turn to protect their wealth? Silver's history as a crisis metal suggests it could be the first choice for many looking to escape the devaluation of paper assets. And with an unstable dollar potentially sparking a new wave of investment into silver, could this be the spark that propels silver to those all-time highs Faber is predicting?
What's surprising to me is that gold hasn't had much of a correction for how long has it been? I don't even know. It's been months. And on the one hand, like, I'm emotionally ready for a correction. Like, if gold were to go down 50, 60, 70, even $100 in some kind of like little crunch, it wouldn't surprise me, but it's not happening. And I looked at the commitment of traders in gold, right? And the worrying thing is that the bullion bank short positions are very near a record high in gold. But what I also noticed is that you go back all the way to 2008, 2009 to 2011, the strongest portion of the gold bull market of that era was after the 2008 crash, right? And then gold goes something from like 642 to 1923 in what was it, from October 2008 to September 2000. So about 3 years. It goes from more than triples, about triples. And in those 3 years, the COTs, the commitment of traders, who's positioned what in the futures market, if you trust those numbers, I don't completely trust them, but I think they're basically accurate, maybe. They look very similar to now. And for most of those 3 years, the bullion bank shorts were at or near records for 3 years. So I'm saying, like, yeah, we're in a dangerous position where you could get people knocked out especially if they're in leverage or doing some kind of crazy trading strategy with options, which I never ever recommend. But those people could get kicked out if they're just trend followers or if they're hedge funds or something. But then again, we had 3 years of this from 2008 to 2011, so we could have that again, and we could just keep going higher from here, just like we did in those years. I don't really know. I'm not gonna try to play it. With silver, silver didn't really make a move until 2010, 2011. So 2008, 2009 didn't do that much. Same thing in the 1970s, like from 1975 to 1979, silver did basically nothing. And then all of a sudden, 1979, 1980, the last half of 1979 into the first 3 weeks of 1980, silver just goes crazy. That's a signal of the public finally waking up, right? The banks wake up, the financial players who see a little bit deeper what's going on in the derivative system, they make their moves in gold before the public finally wakes up. What makes the public wake up? Well, not the derivative markets, the supermarkets. That's what makes them wake up. Then they go for silver. So we're going to see that at the very, very end. Where silver is going to go in the very, very end, of that cycle, in the hundreds, maybe even the thousands. I don't know. It depends. These numbers don't really mean anything when the dollar doesn't buy anything. So I mean, it's anyone's guess, but I do think that the ratio, at least briefly, will fall to 15-1, which is what I'm waiting for. And when that happens, I'm just going to buy a bunch of stuff with silver, and whatever I can't buy, I'll just convert back into gold.
While silver's role as a financial safe haven is central to Faber's prediction, there's another crucial aspect that's driving demand. Silver's increasing importance as an industrial metal. We're witnessing a historic shift toward green energy, advanced electronics, and next-generation technologies, industries where silver is irreplaceable. This isn't just a passing trend. It's a structural shift that is only growing, making silver a critical asset for both investors and industries alike. Let's break down just how essential silver has become. In the renewable energy sector, silver is a key component in solar panels. As the world pushes for cleaner energy sources, the demand for solar panels has surged. And with it, the demand for silver. Silver's unique conductive properties make it an unmatched resource for harnessing solar power efficiently. This demand is not expected to slow anytime soon. According to some industry estimates, the need for silver in the solar sector alone could increase by as much as 85% in the next decade as countries worldwide implement green policies to meet climate goals. Beyond solar energy, silver plays a crucial role in electric vehicles, a market experiencing explosive growth. EV batteries and charging infrastructure rely on silver for their conductive properties, making it essential for the widespread adoption of electric vehicles. The more the world shifts away from fossil fuels, the more industries rely on silver. This surge in industrial demand puts added pressure on silver supplies, which are already limited due to constrained mining output. The supply-demand gap for silver is widening, making it a high-stakes asset in the race to secure future energy resources. But it doesn't end there. Silver is also a staple in the medical and technology sectors, used in everything from advanced electronics to antibacterial treatments in healthcare. This widespread industrial use means that silver has a unique value proposition. It isn't just a hedge against financial instability. It's also a necessary input for future technologies. This dual demand is creating an unprecedented market dynamic. When an asset is both essential and scarce, its value doesn't just increase, it can soar. This raises an interesting question. As silver becomes increasingly scarce due to rising industrial demand, how will this impact its price during a financial crisis? Will we see a situation where silver, already in high demand for industrial use, also becomes the primary choice for investors fleeing the dollar. This dual demand could set the stage for a surge in silver prices, unlike anything we've seen before.
That's a heuristic. I don't know exactly how much bigger it is, but the reason I say that is that if when the mainstream media, I mean, I guess the decent parts of the financial mainstream media, like I'd say the upper class of it, like FT, and they get more academic and more deep into it. They have some good writers there. When they were talking about the basis trade that's being funded by repo, and they started like getting nervous about it, they were talking about 2019 and their apocalypse, and they were looking at the volumes in the 2-year treasury. For some reason, the 2-year treasury has the highest liquidity. So most hedge funds, when they want a basis trade and to snip that little penny off of the difference between the futures and the spot, most of them pick, or a big proportion or a plurality of them pick the 2-year. Right. So when FT was reporting on this, the amount of shorts in the 2-year treasury note were at records at the time. And then they said, oh, don't worry about it. It's going to go down now. The basis trade is out of style and everything will be fine. It's worse than 2019 now, but it's going to go down now. That's what they were saying in their tone. I don't know how they proved it, but they were wrong because now it's at even bigger positions. I forgot the number, but it's an all-time record high, and it's twice the amount of the basis trade in 2019, which was funded by the same repo dollars. Right, so I'm extrapolating. If the 2-year basis trade short is twice as big as it was in 2019, then the problem, at least from that perspective, is at least twice as big. It's probably bigger than that. But I mean, I remember the story of who was that guy, Zoltan Pozsar, and he became famous for like plotting out a map of the financial system and how the 2008 crisis, created a slew of dominoes and they all fell, and he was mapping everything out, and his map became famous. You'd have to be that good in order to figure out exactly how much bigger it is now than then. So I'm saying it's at least twice as big. It's probably bigger.
Now we've arrived at the peak of Rafi Faber's startling prediction, a future where silver isn't just a valuable commodity. It becomes a refuge in a world where the dollar's dominance is unraveling. If the dollar does face a collapse under the weight of an unsustainable credit system and the relentless forces of inflation, we could be looking at a global shift where nations, institutions, and individuals alike seek assets that hold intrinsic value. This, according to Faber, is where silver will step into an unprecedented role. Imagine a world where the dollar is no longer the primary currency for international trade, where countries bypass it to avoid economic risks associated with U.S. monetary policy. As global economies continue diversifying away from the dollar, the demand for stable, tangible assets like silver will grow exponentially. This isn't just speculation. It's a scenario that has played out before. In times of extreme financial instability, investors have flocked to precious metals to preserve their wealth. But this time, silver's role is even more potent due to its industrial importance and scarcity. With both institutional and retail investors seeking safety in silver, Faber suggests that we could see prices reach, and potentially exceed, all-time highs. Silver's unique value as a crisis metal, coupled with its industrial demand, places it in a league of its own. If we look at historical patterns, the flight to precious metals during economic downturns has consistently driven prices upward. And today, silver's industrial applications make it more desirable than ever. The surge in silver demand could create a supply crunch, pushing prices to levels that are unimaginable today. So what does this mean for investors? Faber's vision paints a picture of silver as a cornerstone of financial security in an unstable world. With de-dollarization, credit instability, and soaring industrial demand converging, silver could become not just an investment, but a means of wealth preservation in times of crisis. And while this perspective is compelling, let's remember, this is not financial advice, but an outlook rooted in current economic forces. So are we witnessing the dawn of silver's golden age? Only time will tell, but one thing is clear: silver's role in the financial world is evolving, and those who understand its potential may be better positioned to navigate the shifts ahead. And if you haven't already, consider subscribing to stay updated on these critical developments as we continue to analyze the trends shaping the future of precious metals and the global economy.